Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Benjamin Alt of Schroders Capital to talk about the Schroder Specialist Private Equity Fund. Benjamin, first off, tell me about the fund.
Hi, Alex. Pleasure to be here today, and let's dive into it directly. So, our private equity specialist private equity fund that we launched is very unique in a sense because it has a semi-liquid element, and that is very different to most of the private equity funds you find out there that are closed-ended funds. For this fund, it was important for us to have it highly diversified, to come up with our best global ideas that we source globally through our team, to really make that a product for investors that have no private equity exposure, that want to access the asset class, but on a broadly diversified basis, combining the best ideas that we can offer.
So tell me about Schroder Capital and yourself.
Sure. Schroders Capital, we introduced the name in June this year, and within Schroders Capital, we combined all our private assets activities, namely private equity, real estate, private debt, private infrastructure, securitized credit, ILS. Myself, I joined the firm 13 years ago. Most of the time, I was a senior member of our European private equity activity. This year, I took over responsibility of all our private equity global pools, and I'm the portfolio manager of the Gaia 2 Specialist Private Equity Fund.
So what does the fund aim to do?
The fund aims to participate in the most attractive private equity segments globally. That would, in our view, and those are also the core pillars of our private equity strategies for the last 20 years. So this fund is not a new strategy idea in that sense. It's just a wrapper. The liquidity element is new, but what we do there is exactly what we also do in our closed-end private equity fund. So what is it? In the Western world, we have a really strong focus on the smaller end of the private equity market. So what we call the small, medium-sized market segment. We have a tiny bit of large buyout in there as well, and the rest of it, roughly 1/3, is venture growth investing. The growth part primarily in Asia, which is also roughly 20% of the fund. The other 80 would be Europe and US. How we invest that capital is through co-investments, direct co-investments, through secondaries and primaries. But the bigger part here, 80%, will be really through co-investments and secondaries. Why is that? Those strategies help us to deploy the capital as fast as possible in best opportunities.
So why should investors consider private equity?
First of all, it gives you the opportunity to add return and diversify your portfolio. And this is always what we're looking for in investing, right? You want to have a higher return, you want to have a better distribution and diversification in your portfolio, and private equity can add that. Private equity is young as an asset class. It's part of the alternatives assets, and for many, it was it was too complex. They didn't want to really go into it. They didn't understand it, or there was just a lack of having the right partner to help them with. And I think this is now, with many providers in the market, where we have been really around for more than 20 years with great performance. We think investors should, when they are not experienced, look for such a partner to give them access to that asset class.
And it's always been the preserve of institutions or very, very high net worth individuals. The industry as a whole is now sort of trying to encourage private investors into this, so-called democratizing private equity. Why, if it's so easy for them to get money in the first place, why are they so keen to do this?
It is really broaden it up. Why should it be so exclusive? Why should only institutional investors have the chance to have access to that great performing asset class? We try to really come up with solutions with an access for those private investors, or reduces the complexity to enter the asset class and gives them the comfort to do it, because it's not risky as perceived in the old days. it's not too complex, and it's not always like the minimum of 5-10 million that you need to bring to access that class. And this is really changing in the industry now, which we think is great. As it not only offers private investors to enter the business class, it also makes our business more stable, diversifying, and we think it makes a lot of sense to see private equity in every private portfolio.
So how do you find these opportunities?
Very important question, and you constantly have to source, especially in private equity. There is not that fixed set of public listed companies you can pick from. So you need a team, and for us, very important as a firm, since we started for the last more than 20 years in private equity, we thought like you need local people investing in local strategies. So we have more than 50 investment professionals globally, sitting in New York, in our New York office covering the US, in Zurich and London covering Europe, and in Beijing and Shanghai covering the Asian markets. And all of them are sourcing every day, and not only for this fund, for all of our funds and mandates.
All right, tell me about some of the companies you've invested in and why.
Sure. I mean, let's go back to more the beginning of the fund life. We launched the fund in 2019 and obviously started straight with investments. It's always a bit more interesting to talk about opportunities that you can also see the progress, and also I give you two examples where we also see like an exit process or an exit horizon that is very close. First company I want to mention is Innit. It's a company we backed together with our fund manager Amaran in Germany. Innit is a digitalization consulting firm in a wider sense. So it helps medium-sized and small and medium-sized companies, but also a lot the government of Germany, different political institutions, communities to digitalize processes. We backed the company in Q4 2019. In Q1 2020, we were not so sure where the market go through COVID and everything, but COVID totally accelerated that process of digitalization. So you can imagine that company heavily grew through last year. And 2 years later, there might be an exit coming very soon at a very, very high money multiple. But it was a great company we liked from the very beginning. It showed good growth. It totally helped many companies in the industry that needed to digitalize. I mean, we all know how many companies are far behind that, but also what we liked at the time when we entered, that 60% of the revenues were with the wider state of Germany in a way, so that gave a lot of downside protection and less dependency on projects. Overall, very successful case. I hope next time we speak, I can give you straight numbers. It's a bit tricky. It's in an exit process, but we think it's going to be a great outcome. The other company I would like to mention is PopMart. PopMart is an design toy company. First, in all honesty, when I read the IM, I said like, okay, what is this? But when I looked into it, we got really excited about the company. It's China-based. They are producing those like little art toys. Those are toys that have a huge collector's market, especially in China, Japan, and South Korea. And we liked the idea more and more the more we looked into the company. They have a broad range of toys that are very popular. So it's not like a one-hit wonder kind of thing. They showed tremendous growth rates. We're talking about like doubling the company every year. And we knew when we entered the company last year that an IPO is the obvious exit route of that company. So only 6 months after we entered the company, they went for an IPO last year in Hong Kong. And just through that IPO, we almost five-folded the value for our holding in the company. And now we did the first partial exit in the company. And yeah, it's trading well, and I think it was a real success case for early success case for our fund.
Are there any other exits you would like to talk about?
Yes, I mean, one part of the portfolio that is very important to create that liquidity needed for the semi-liquid nature of the fund are secondary transactions. So we are buying into a portfolio of deals. And here we bought a very attractive portfolio from SF Equity. It's a fund manager that focuses a lot also on consumer deals. And one of the companies, the early stars we identified, is a company in the organic spices and herbs space. And only 3 months after we closed that whole transactions, we were able to sell that single company out of the portfolio, which resulted in a 60% uplift of our invested cost in 3 months. So that was an other early good success, and especially early liquidity back to the fund.
Obviously, not all investments are going to succeed. Have you had failures?
Touch wood, so far not. In this fund, obviously in our history we have. I think an interesting status where when you look at buyout deals and 2/3 or a bit more than 2/3 of the portfolio will be buyouts, then we experience like 1 out of 10 or even lower industry average. I think is 1 out of 10 is not going exactly according to plan. This happens, and it can have many reasons. One of the reasons that we see a lot is the management is not the right for the journey that you have seen or foreseen for the company, and then it's very important to act fast and maybe look for support, strengthen it, or completely replace it. But touch wood, especially on the direct co-investment exposure that we have, all companies are on plan, and we are very happy with that outcome, especially looking what happened what happened with COVID and what we experienced last year. But I think also one of the drivers why that portfolio is very robust and stable is we overweighted a bit healthcare, business services, and technology, and all those 3 sectors went very well last year.
Can you talk about the structure of the fund and the liquidity?
Sure.
Because it's not a fund which type of fund many people would be used to investing in.
Absolutely not, and I think that's also the beauty of it. The beauty of it in a way that now much more people can access the asset class, and it has always been one of our goals with the thinking around democratization of private equity. The fund itself is a SICAV Part 2 structure, and that allows exactly for those liquidity elements. So if you want to subscribe to a fund, you can do so on a monthly basis. So T-10 end of the month, 10 business days beforehand, you have to hand in your subscription, and you will enter at the net asset value at the end of the month. This is also very new in private equity and great, because it's not trading at a discount to NAV. You really enter at NAV, and you also will exit at NAV. So let's say you stay in the fund. We always tell investors it makes a lot of sense to stay in the fund a bit longer, for a year, 2, 3, 4, 5. But you always have the option to go out. It's a bit limited because it's not a fully liquid solution. You can't have the best of all worlds. But how we handle the redemption, it can happen on a quarterly basis with T-90. So if you want out June 30th, you have to hand in your redemption request before end of March. And there is a limitation to it. So we say that we want to provide redemptions in every given quarter at a 5% net redemptions in relation to the net asset value of the fund. So we guarantee in a way, or we want to pay out 5% of the net asset value if needed every quarter.
Finally, Benjamin, if an investor's looking somewhere to put some of their money this year, why should they consider your fund?
I mean, first of all, it is very unique in a sense that there are just a handful of similar opportunities, not even the same. I think we, with our strategy on very highly specialized private equity segments globally, with that track record and that experience, is unique to find. It hasn't been easy accessible over the last years because you had to be an institutional investor. The minimum was 5 million, not like $50,000 that we have today. And I mean, for me, living and breathing that strategy for the last years, I really think it's one of the most attractive spaces you can be in private equity. It's globally diversified, so it's not a high risk strategy. Even we talk a lot about specialized, highly attractive, high return. That often triggers for people, oh, it must be risky. No, it's not, because you have that broad diversification of currently more than 100 companies. I think by year end, over the next 12 months, we will double that. So now also with the fund growing, you will even have more diversification. And we are on a really good journey. We will be at around 500 million by the end of the year. So this is like really proven over the last 2 years, also with great performance, that it's a valid strategy. And it's really not easy to find other opportunities in that space.
Benjamin Alt of Schroder Capital, thank you very much.
Thank you very much, Alex.